Good morning, everybody, and welcome to today's webinar. Private capital, what are your options, is our topic today. Look, I'll just start briefly with a couple of introductions. So my name is Shaun McKinnon. I'm a partner in the advisory practice here at BDO, and I do work across both our restructuring and corporate finance practice. I actually have a specialisation in food and agribusiness, and as part of my role, I've been involved in placing private capital transactions both on an equity and a debt perspective. And that's partly what we'll be talking about today. Joining me as my co-presenter is David Ward. David's a partner in our corporate finance practice. David's also the leader of our M&A practice here in Queensland and has extensive experience with private equity transactions, both on the buy and sell side. And he'll be lending his experience in that sector today to our website.
Good morning, everyone.
All right, so look, just a little brief overview of what we're going to cover today. We're going to do a quick recap of the COVID environment, some of the impacts that has had on capital markets, and in particular, what it might do going forward. Then David's going to talk to us around what is private capital, and then he's going to go through a little bit of an overview of the private equity side of private capital, how you access it, what are the characteristics, who are the players, try and demystify it a little bit for you. And then I'm going to look at the same set of characteristics around private debt before we talk you through how you would typically access the different types of private capital, and then recap on today's session. So we'll get straight into it. So look, we're going to start off, as I said, with a little recap on the COVID environment, how that's impacted capital requirements. And private capital in particular is an area that has become significantly more prevalent over the last decade or so. And what we're hearing a lot of our clients talk to us about at the moment is that they want to understand more about it. They want to understand how you access it and when they can use it and the terms and conditions on which they might be able to access it. So the purpose of today's webinar really is to give, I guess, a bit of a 101 on private capital, so that when you end today's session, we hope that you come away with it with a greater understanding of what are the different options, where they might actually suit your particular businesses, and then how you might be able to go about accessing it if you think it's appropriate. So we'll talk briefly around a little bit of this COVID-19 impact. So going back to March 2020, that's when it really all hit here in Australia, as we're all aware, and that's when the government announced the first range of shutdowns. And that obviously had a significant impact on a series of different businesses across the country. Preservation of capital was the norm for everybody, including BDO. And what we saw was people worked hard to maximise their working capital positions, preserve capital for the unknown that was coming, and made a real concerted effort to be conservative during that period. Private capital investors, they were no different. So preserving capital for their investee businesses and saving dry powder for opportunities was a consistent feedback that we got from our different private capital contacts. In particular, there was, going into this COVID-19 period, there was widely regarded to be a lot of capital in the market in this sector, and importantly, a lot of what we would call dry powder as a consequence. And the discussions that we've been having with a lot of our private equity and private debt partners is that at this stage that they're waiting to see what happens with the COVID environment to understand where they can deploy that and what opportunities might come out of that. It's important to comment too on the government support measures that have been providing much needed breathing space for businesses right through the different sectors of the economy. JobKeeper in particular has seen government effectively become a quasi-equity provider. They've made material cash payments to businesses across all different industries. And as we move forward, those are going to start to come off. ATO repayments have been a huge way of preserving capital by pushing repayments down the line. There was obviously things like the ATO cash boost. We've seen payroll tax refunds and deferrals that have been provided. All these things have acted to be able to support businesses impacted through the COVID period and help them preserve capital in the short term. Key stakeholders have been a party to helping as well. So banks in particular came out pretty early in the piece and offered a series of support measures. Landlords have had mandated provisions put on them around how they have to deal with their tenants. But all of these measures have been successful and they help businesses preserve their capital position. Now, let me just move forward. Okay. Now, some businesses have actually been positively impacted. So what we obviously have seen is that while there's been some stress, there's also been some businesses that have had their record trading periods. And we've talked to some of our clients that have seen circumstances where sales have increased materially during this period. And we've listed a few of those particular businesses, or industries at least, on the slide there. What's important to keep in mind, I guess, is that when we're talking about private capital today, there's a whole range of ranges of which you can use it for. And some of those are to deal with temporary stress, but some of those are obviously to fund growth opportunities. And that's something that, we think private capital will be really prevalent in as we move forward. So those private capital sources that we'll discuss today, they are 100% active and looking for opportunities in the market, right across the spectrum of industries and sectors. Now, as we move forward, the government support measures are starting to expire or reduce. So JobKeeper is being wound back from September 2020. It'll be fully withdrawn once we get to March 2021. The ATO and payroll tax deferrals are falling due. The cash boost is going away. Major commercial banks have given 6-month holidays for principal and interest, and those are effectively expiring around September and October. They've indicated that they'll give another 4 months of assistance to clients that really need it. But unlike the first time around, they've indicated that that support will be provided subject to particular due diligence. And when I say unlike the first time around, what we saw back in March and April was that if you wanted to defer your principal and interest repayments, you just had to ring your bank and tell them, and they would do that. There was no due diligence attached to that. This time around, we are going to see significant amounts of due diligence from those banks, and we expect it will be much harder to access additional holidays in that respect, and you'll really need to be able to demonstrate how that's going to be repaid. The Landlord-Tenant Code of Conduct was implemented earlier in the year. That was initially meant to be for a 6-month period, and that's starting to roll off around September, October as well. Although we have seen in the last week or so that in Victoria, they've extended that for another, I think, 3 to 6 months. But the key point, I guess, with all of that is to understand that what we are seeing is that since COVID happened, there was a massive amount of capital injection or through things like JobKeeper, or alternatively measures put in place that allowed businesses to preserve capital, but those are going to start rolling off as we move forward. And as businesses start to understand their true trading positions and what the future looks like for them, and as some of these measures roll off, we're going to see businesses that need additional capital to either fund growth or to bridge particular periods in time where they might be strained for capital as a consequence of the current operating environment. Now, as we see these particular scenarios unfolding, we think that some of the traditional sources of capital, such as major banks and owner equity, are going to be constrained. We're already seeing some of the major banks showing tighter credit policies, and obviously leading well into COVID. And post the GFC, we've seen significant amounts of changes to the way APRA regulates those operators, and that's tightened credit policies even before this. And certainly, as they're dealing with a lot of potential distress in their own books, they're going to be very careful around how they assess new loans and get money out the door. We're already seeing upward pricing pressure on new loans coming through some of our clients. From an owner equity perspective, while there's uncertainty about the future, this is going to make owners cautious. And if they're in circumstances where they need to provide additional capital, whether or not they want to do that at the risk of putting forward personal assets, most likely as security, is something that they really need to think about. So potentially now is some of the time to share some of the risk, or at least de-risk some of your investments through the potential use of private capital in some circumstances. So look, with that introduction, David, I now hand over to you to talk us through the next section of our presentation.
Thanks, Shaun. So I'll briefly touch on what is private capital, and then delve into a bit more depth around private equity, which is one component of private capital. I think the key dynamic here about the private capital market in Australia is that it has increased significantly in recent years. The size and the use of that private capital market lag significantly behind what happens globally. I think for the reasons Shaun touched on, both around APRA, post-Royal Commission and plus COVID, the emergence of private capital as a source of funding is only going to increase significantly in the short to medium term. So private capital it is now an asset class that there's a lot of investor enthusiasm for, which is what is providing the availability and deep pools of capital that's available outside of the traditional methods. So in terms of what is private capital, it's more than just straight private equity. I mean, private equity has historically been the dominant form of private capital, but certainly a whole host of other private asset classes have and are continuing to emerge. Now, generally speaking, it's capital that doesn't come direct from the traditional institutional sources, being the banks and government and public listed company. It's funded from a range of institutional super and pension funds, but more so and prevalent in recent times and going forward is those of private individuals or groups of private individuals that are represented by a manager and seeking above market returns. Also, we're seeing the emergence of family offices acting as managers with its own fund, providing all different forms of asset classes across private capital. Now that private capital includes debt and equity. I'll talk to equity, private equity, and Shaun later will touch on private debt. And look, it's generally unregulated by government or rules of the stock exchange, which I guess is a key driver around the flexibility of private capital and the ability to be quite innovative in how a business may fund itself going forward with the use of private capital. So I might touch on the next slide, Shaun, around just the different sources of private capital. As I mentioned, whilst private equity has traditionally been far and away the biggest component of private capital, other forms of private and alternative finance have grown, both in popularity for end users, but more particularly in relation to the depth and availability of the amount of capital. So private equity is usually, typically involves a party taking equity stake in the business. Yes, they'll have decision-making influence, and private equity tends to play across different stages of a business's life cycle related to buyout, growth, venture, and turnaround. Whereas private debt is pretty broad. It can be traditional debt instruments. I think it's fair to say that private debt doesn't necessarily mean it's not taking traditional senior debt positions. It used to be very much mezzanine and more higher risk type lending, but private debt is certainly playing in the more traditional debt instruments in the current environment. Like private equity, they tend to be much more flexible with respect to T's and C's and covenants, LVRs and repayment structures. Unlike private equity, and that's probably is a big difference, it is more passive money in the sense that there's no influence on decision making, whereas private equity as an equity holder will have a big influence on that. Though private debt will take traditional security over the business and assets, including personal guarantees, etc. And that obviously has its own consequences of loss of control if unable to meet your obligations. And it's very flexible about the use and the purposes that private debt might be taking on, whether it be bridging finance, growth or expansion, working capital, term debt. And I think it's kind of obvious to say that private debt and private equity can go hand in hand, where private debt can fill a funding gap that is needed to top up any equity. So how is it different to traditional sources? I think as we've touched on, it's not regulated. It's not subject to the same level of regulation as institutional providers. You know, not all the time, but often sort of the credit process is different. The risk profile is very different, and there's flexibility about how that risk profile can be priced or would be priced. Certainly provides more flexible capital solutions. T's and C's aren't stringent. There's a lot of flexibility about negotiating to suit the needs of the business and also the provider, and price and risk will be factored into that accordingly. As I mentioned, the structure and the investment is totally flexible, and there can be a combination of equity, debt, quasi-equity / quasi-debt with convertible instruments, etc. And it is usually very covenant light. Certainly on the equity side, though, of private capital, it often does come with greater oversight and connectivity into the business that the investment's being made into. But alongside that capital is expertise, and arguably, the fundamental question I take on private capital, private debt, if the private capital or the private equity, sorry, versus private debt, if the private equity is not providing you some more value other than just money, well, private debt would probably be better. So usually the equity is accompanied by particular expertise, future funding, etc. So I'll move on now to talk more specifically about private equity before Shaun delves into private debt. So I guess the first question is, what is private equity? So it's a general term used to describe a collective industry of specialised fund managers, and what they're about is investing and acquiring equity stakes in businesses, which can be both majority or minority positions, but ultimately with the aim of an ultimate sale of that business. So in essence, private equity is a path to a future liquidity event. They raise funds from institutions, mainly superannuation funds, but again, as I mentioned, more and more we're seeing high net worth individuals and family offices invest directly into the private equity funds. Now, it may take the form of a purchase of shares from an existing shareholder or an investment in new shares, providing fresh capital to the investee company. In most cases, though, it's generally both types of funding, i.e. some cash out by selling down existing shareholding and bringing in new capitals to fund the growth opportunities that exist in that business. Private equity funds make their money from capital profits, so it's all about capital invested and capital taken out at the end. Generally speaking, and there are exceptions, most private equity funds are capital profit focused rather than income from dividends and fees and interest payments, etc. So I think one of the things about bringing on private equity is dividend policy, and generally speaking, the dividend policy will be all about reinvesting funds for growth, as opposed to necessarily investing for an ongoing dividend yield from that private equity investment. But the key focus of private equity and private capital, full stop, to be honest with you, but particularly private equity, is they have a laser-like focus on growth during a relatively short period of time. So I'll talk separately about timeframes, but it's all about maximising capital growth, and if they can do that in the shortest period of time, that improves their internal rate of return, which is their lifeblood to raising future funds. So what type of private equity are there? I guess there are four broad categorizations here, and there is some blurring in all of these. But there's venture capital, and this is typically seed or very early stage investment in startups and young companies with little to no track record of profitability and in a number of cases or even revenue. So it's all about minority investment and backing a management team / founder and the development of some form of IP that has been developed by that founder. Growth capital is generally targeted at profitable but still maturing businesses with significant scope for growth, and that scope for growth piece is important. It's generally where existing owners need external capital and expertise to take the company to the next level and realise its full potential. And growth capital, private equity tends to be much more of a partnership style investment model, where both parties are in there with ostensibly equal rights and all focused on the same outcome, which is growing the underlying value of the business for a future liquidity event. Buyout funds tend to be larger, and they are typically large majority control investment, and historically use high leverage in terms of funding the acquisition. And that's generally targeted at large, established, mature companies, and it's about improving operations and/or financing, or going on a massive buy and build or particular consolidation in an industry strategy. And the fourth category is turnaround / distressed, comes in various terms, and this does relate to businesses facing difficulty that need capital to address these issues and are unable to obtain it from traditional sources. So the incoming equity provider would seek to transform the business and typically these tend to get acquired at lower valuations given their stress situation. I think this is the interesting piece about post-COVID and how this is going to play out. I think the traditional idea of distressed businesses being bad businesses or businesses needing turnaround, having some fundamental flaws, is probably going to be flipped on its head, and there'll be some good quality businesses that might be distressed simply for the absence of being able to access the capital they need to take advantage of opportunities. So I guess that's the watch this space one coming out of the immediate COVID-19 situation we're in. Couple back, I think, Shaun. Thank you. So what's private equity looking for? I think, as I touched on, PE firms get very active in future growth. So they look to actively manage businesses to improve efficiencies and drive value. And this is all about concluding in a sale within a reasonably accelerated time frame, be it 3 to 5 years in an ideal world, when their gains are realised. So as such, they're looking to work with companies and their management teams with the greatest potential to increase that value or future equity. So what are some of the characteristics, therefore, that they look for in trying to find those opportunities? First and foremost is a demonstrable track record, and I think coming out of COVID, that's going to be equally important. Resilience through what's occurred is going to be a big litmus test and big KPI for future investment opportunities. Recurring contracted revenues slash strong cash flow generation is important. So cash is king from a private equity investor's point of view. Strong market position in the market in which the business operates is important. Opportunity to enhance efficiency potential going forward. Now, that's not to imply that systems, controls, management teams in place at the moment aren't adequate, but maybe there's gaps that can be filled to further grow that value. Having growth potential is key. Having a realistic business plan, a proven management team, scalability within the business model or the sector is important, and something that needs fixing, which may or may not be due to factors specific to that company. It could be industry, it could be the economy, it could be COVID. So that's kind of a broad brush list of characteristics that PE will focus heavily on. I guess the question of how does private equity add value, and I think my comment earlier about if private equity coming in with equity is not adding value more than just money, well, private debt is arguably a cheaper source, if you like, because of the lack of dilution involved in not giving away equity. But the value that private equity does and can bring is that, firstly, there's an opportunity to de-risk. So for a business owner, there's an opportunity to do a partial sell down, de-risk and take some money off the table. And by being joint equity holders and equal in that category, there's heavy alignment about the future going forward and what's trying to be achieved, which would be agreed up front what that end goal is. I think the other thing about de-risk is to bring on an equity provider would remove personal guarantees and other debt covenant heavy type attributes that might be existing in the business. I mean, what private equity should be able to do, if it's the right partner, is provide access to best practice. So, for example, if the growth strategy is to acquire competitors, the equity provider would have very strong M&A capability, for example. They'd have strong networks into that sector that can help open up a new market. Funding to accelerate growth. So with a private equity provider, you've got a balance sheet and an equity partner whose lifeblood is putting money to work. So for the right opportunity, there is an untapped capability to access capital. Again, where they may have some particular industry expertise, they can certainly enhance strategy and the business plan. They'll be very active performance management. They don't run the business day to day, but they'll certainly have some KPIs around how we're going and benchmarking on a monthly basis against the agreed end goal of maximising future value. And it is often, generally speaking, easier to attract talent and management capability within a private equity-backed company in terms of people wanting to join that type of business with a strong growth profile and an end outcome, particularly where there's strong management equity schemes in place, which there would be with private equity. I guess the question I'm going to ask is, how do they operate? How does private equity operate? How do they control the business? So, the short answer is whether they're minority or majority investors, that there's certain controls they'll have. So, they need the ability to exit, for example, whether they're in minority or majority position. So that's common to whatever position they take in the business. But look, before getting to bed with private equity, there would be a very detailed shareholders agreement that establishes the rights and obligations of the company, its management and the investors. Within that will be limitations on certain actions of management without the consent of the investors. But likewise, where the owner retains involvement in the business and has a meaningful shareholding, for most material matters, mutual consent rights to key decisions are common, which is akin to the partnership style investment model. The reporting requirements would increase, but more around the PE investor having full access to company information and board minutes, etc. And I guess the whole culture thing of having private equity investor on board is a culture and incentive system that rewards success and rewards success highly. But yes, it does penalise failure. And I think that's where the control provisions come in for private equity. Again, regardless of their equity position, the right to step in where things go not according to plan is paramount to them. Conversely, though, and arguably, if things do go bad, you probably want them stepping in the sense they have third-party funds from superannuation funds at stake. So they work pretty hard to rectify problems where they occur. So in terms of important considerations for private equity, I guess, control we've talked about, and depending on the investment size, it doesn't necessarily mean that private equity has full control of the business, but certainly there is a dilution of control by bringing on private equity. It's likely that the PE investors will increase their reporting requirements from that the business currently has pre-private equity coming on board. I think there is a real possibility for future dilution as the private equity firm contributes future equity funding. Again, that's a decision that's made at the time, but the overriding assumption here is that it's good for the business for whatever that future funding need is, and then the dilution may well be the best thing and palatable for the existing owner. I guess private expenditure, where that's able to be taken advantage of in a true private situation, does disagitate somewhat with a private equity player on board. And I think, just to come back to my earlier point, bringing on private equity is the start of an exit strategy. So private equity has an exit horizon. It's typically 3 to 5 years. So bringing on a private equity investor needs to align with a motive and willingness to fully exit in a reasonably short time frame, or short to medium term time frame. Thanks, Shaun.
Thanks, David. So I'm now going to talk us through the private debt side of this equation. So look, the term private debt typically refers to credit provided by alternative or lenders or private lenders, and those are ones that sit outside the major financial institutions and banks. They typically include investment funds or credit funds, and these are a very, very broad spectrum of lenders, which have become even broader over the last decade or so, as all sorts of different investment funds, from those that, I guess, the common ones have been property related and property funding funds, right through to more broader investment managers, fund managers, credit funds that have set up to do direct lending, to lend into specific sectors, for example, agriculture. But I guess the key point I just wanted to make there is that while we're talking about that group, it's effectively large amounts of capital funded from the same sources that private equity comes from, but that are finding homes through all sorts of different types of debt, and debt that traditionally, and I'll talk about this a little bit more in a minute, but debt that traditionally is very similar to what you would get from a bank or other similar financial institution. It includes also family offices, high net worth individuals, and this is really interesting. Over the last little while, we've started to see more and more family office and high net worth individual clients that are providing direct lending, senior facilities, very much in the same terms that a bank previously would have, other than the fact that there are some positives and negatives, which I'll talk about shortly. And then traditional private equity firms are more and more entering the world of credit, direct credit. Now, these products that they offer are very similar to banks, but critically, the two things that are different are the fact that you have very flexible terms and conditions, and that extends to everything from covenants to loan-to-value ratios, repayment structures, etc. But the downside for that is higher interest rates. And that flexibility, I should also say, extends to things like how quickly they can get capital out the door. Some of the decision making that they make is typically a little bit more commercially focused. And when I say commercially focused, I mean things like, for example, dealing with the emphasis that a private debt provider might put on management and their track record, and the ability to look at things past the numbers that might be a bit tougher from more highly regulated funds, such as banks. Private debt's not regulated, obviously, by APRA the same way that the banks are. They've significantly grown their market share post the GFC as higher capital charges and stricter lending processes from regulators have impacted the supply of credit from banks. And this has been a real issue, and not just those different lending practices and the different regulatory provisions that they've had to deal with, but you look at things, for example, like the Royal Commission into Banking, and banks have become a lot more circumspect and careful about how they put money out the door, and really concerned about things such as public perception of how they enter loans and how they might actually recover them. All of these things have allowed the private lender and the alternative lender market to really grow and flourish. So look, let's have a look for a minute around what are the key types. And David touched on these in the earlier slides, but obviously we've got senior lending, primary lender, first ranking security, usually backed by some sort of real estate or asset security. The rates vary, but what we're seeing in the private sector can start as low as 5 or 6% for certain assets that have particularly low risk, but typically are more likely to be in that 8 to 11% or even higher market, depending on the particular type of asset and the typical type of lend. This type of debt now is offered by all types of lenders in this private debt sector, but the terms are very different. So what we see is that, for example, a lot of the fund managers that have credit funds, they would typically have probably a larger fee structure. They would typically have a slightly higher interest rate, but you would have less direct control over your investment because you're a part of a larger pool of funds. Whereas if you're for example, a family office, or even some of the more specific credit funds that are lending directly into a particular type of lend, some of those funds, for example, might take a slightly lower interest rate to have that greater degree of control. Mezzanine lending, very typical secondary lender, second ranking security, personal guarantees, the same you would on your senior lending, still asset backed, but obviously they're sitting behind somebody else as the first lender, so they can have a slightly different profile. They are often sector specific. The rates will typically be double-digit rates for these mezzanine lending. It's obviously higher risk, so they require a higher return. And typically there are investment funds that service this sector of the market. We also see cash flow lending. These are loans that are secured against businesses. Obviously they're going to provide personal guarantees from directors, but not asset-backed. And then special situations, which are lending typically to distressed or challenged businesses. It's much higher risk lending. They'll seek returns to match. quite often there'll be the prospect of what we would call a loan-to-own scenario there if circumstances don't work out the way the business wants them to. Really what we're trying to highlight here at this slide though is that when we're talking about the types of private debt, in today's world, in 2020, it's very much similar to what you would get from any other major commercial bank or commercial financier. The private debt market has extensively changed and now offers a genuine alternative, with the two key things that change being terms and conditions and price. So who are they? I've already touched on this initially, but I'll talk about it in a bit more depth. So investments in credit funds, investment funds and credit funds, very broad church. They invest in a range of ways, either through portfolio of loans or direct lending. They typically raise their money from wholesale or institutional investors. So you think everything from super funds, insurance companies, high net worth individuals, family offices. Interestingly, the terms on their loans will typically be shorter than what you would get from a major bank. And we see that they typically prefer shorter terms. Between 1 to 3 years is probably the preferred option. And they will still look at loans that obviously will go for significantly periods longer than that, but they'll only commit for sort of 1 to 3 years, sometimes up to 5 years in the first instance. And at the end of that period, they'd look to renegotiate if they were going to roll over. As I've already touched on, the interest rates are typically higher to banks, but very much subject to the asset or the deal. What's becoming more prevalent as this type of lending adjusts is the ability to get, I guess, more competitive rates in the context of where the bank rates might be. And the real benefit in this scenario is that the terms and conditions are incredibly flexible. So we've seen circumstances where, for example, an investment fund or a credit fund might lend into a particular business that has a serviceability issue that can't be met by a bank. So asset rich, but for whatever reason needs some bridging finance to get through a period where their cash flows are low. A normal bank might not be able to deal with that because of the fact that they don't have the servicing capacity to meet the relevant regulatory requirements. However, an investment or credit fund might be able to take a more commercial view as to the future prospects of that business and enter into some sort of arrangement that will in fact fund and even potentially capitalize some of the interest until the cash flow position adjusts over time. Special situation funds. These are obviously those that are focused on distressed situations, and they're particularly looking for a high rate of return. Often they'll try and enter into previous debt positions, so they'll look at things like acquiring debt from major banks. That's something that happened quite extensively post the GFC, especially as we got sort of 4 or 5 years into that environment. They would effectively acquire the loan at a discount from the existing financier, and then they would either recover those loans in the normal course. If those loans failed, then they would typically engage in, I guess, either a loan-to-own strategy, or they would force the recovery of those assets in a quicker environment than what might have otherwise happened had they stayed with their original bank. And look, that's something that's really got to be quite important for anybody considering entering into these scenarios, is that if you are dealing with those type of funds, you really need to be quite clear about what you need to do to be able to get your outcomes and what are the options for them to exert leverage over you. One point I will make about those type of funds and I guess that acquiring loans off existing banks is that in the post-GFC environment, we did see scenarios where banks would sell those loans without any reference to the customer. And typically there are terms and conditions in the normal T's and C's of loans that allow them to do that. And while I understand most of those T's and C's exist still in a lot of the loan documents that would have been signed by major commercial banks, the operating environment with those major banks now exist post the Royal Commission is such that it's very unlikely in our experience that they would enter into those loan book sales without getting consent from the borrower in the first instance. Family offices and high net worth individuals, they've really shifted over time. We saw that type of lender being someone that would invest into an investment fund or some sort of credit fund they'd be one of multiple investors in a portfolio of loans, or potentially sometimes, especially in property, they might be funding as part of a group of people, an individual project potentially, or a smaller group of projects. But as we've seen the world progress, those family offices and high net worth individuals have more and more started to become direct lenders. They will engage through their own structures direct with private companies on a senior debt basis on a very similar way that a major bank would. They will look to get higher rates, although typically, in my experience, those rates can be a little bit softer than what we would see from some of the investment funds, credit funds, fund managers, etc. And they can typically be just as flexible on terms and conditions. And traditional PE, we're now seeing them become much more active in private debt. In an environment where we've got particularly low interest rates and operating conditions are a bit tough at the moment, private debt, especially in positive, strong businesses that have an interim need, is something that can give them an above market safe return for the right business and lend. So what are they looking for? Not really rocket science, but generally they're looking for an alternative investment opportunity with reasonable security and steady returns. And the different types of lenders that I've talked about today will all have different hurdle rates, and they'll have different motivations for the type of lens that they do. But what's key, I guess, and there's really been the growth of this private debt market, is that in an otherwise difficult market to obtain returns, for example, from typical fixed interest securities and other stock market type investments, private debt is becoming a much more realistic opportunity for some of these different types of investors to be able to get an above market return. They'll be seeking opportunities to invest their funds with a quality counterparty. And one of the critical things that private debt players look at is a strong management with a clear strategy and a business model. You need to be able to articulate that. You need to be able to demonstrate good financial information. You need to be able to demonstrate robust and clearly articulated financial forecasts. You need to be able to demonstrate your ability to meet what you say you're going to meet. And obviously the quality of the assets, the valuation of those that are security that support these loans is something that's critical. And David will talk about this in a little bit of time when we talk about how you access it, but having all your ducks in a row when you're dealing with this when you're trying to approach this market in terms of the right information you present is really important. Now, obviously, as we've talked about quite a bit, they will expect higher rates of return than available from commercial banks, but in return, you're able to get more flexible terms and conditions, and they're likely to be less restrictive on covenants and reporting. How do they operate once invested? Well, typically in our experience, they're generally quite hands-off, provided that their loan commitments are being met. They're obviously going to monitor those key milestones and the progress, but our experience is that what they're looking for is a relatively straightforward, stress-free investment, and provided those loan repayments are being met in the terms in which you've agreed to, they're typically quite easy to deal with. Expect, however, that they're going to be more proactive than a commercial bank would be if things go wrong. If defaults do occur, or requests are made to alter the terms, for example, repayment dates and timeframes, they'll become more active. They're typically closer to the money in some circumstances, like family offices, high net worth individuals. It's coming straight out of their own pocket. So as you could imagine, they're going to be a lot more specific about how they get across those types of situations. They don't have the APRA regulations. They don't have the current public perception issues that major banks have that create some difficulties in some of those major banks dealing with distress situations. So be aware of the fact that in those circumstances, they're going to be a lot closer and they're going to be a lot more proactive in how they deal with it. Now, depending on the lender, they may be more or less likely to enforce security or leverage the right to enforce security for some sort of commercial gain. And this is just, I guess, a bit of a be wary thing. What we're seeing as the private debt market has extended and the different types of lending has become so much more similar to senior first ranking secured debt, that the general types of lending in there is pretty strong, and the way that they deal with that is very similar to a bank in many aspects. However, there are different different sectors of this market that if things don't go well, they are very much driven by returns, and they, depending on who your counterparty is, they could be in a position where they actually try and leverage their position for an outcome that isn't necessarily going to be as positive as one that you might get with the commercial bank. And I say that in the context that where we're seeing clients that are banked by commercial banks at the moment that are in some form of distress, then those banks are very, very reluctant to enforce securities, for example, more so because of the public perceptions around that rather than the financial circumstances of it. Whereas these private lenders won't have those same concerns. They certainly will be worried about public perception and doing the right thing in many cases, but they are going to be equally, if not more, driven by the financial outcomes that they're trying to get for their investors or themselves. So just in summary, pros and cons. First of all, private debt is so prevalent now, and there are significant amounts of capital from all different types of lenders, but they're all very flexible around the terms and conditions. So if your loan to value ratio isn't particularly right, your servicing capability is making it difficult to get access to capital from your normal bank, then private capital is a realistic opportunity. They'll lend in circumstances that therefore the commercial banks may find it difficult to lend in, and they can do it with less red tape, and they've got easier access to funds and can move a lot quicker to provide that funding, which is important in certain situations for a lot of businesses. The downside is that you will typically pay a higher interest rate depending on the type of loan you're after and the type of lender that you access. Those interest rates could be significantly higher. You have less protection from regulators, and in circumstances where things don't go well and you do have a default, they're likely to be more aggressive than a normal bank commercial lender. So that's all I wanted to cover in that section. David, I'll hand it back over to you to sort of talk us through how you would access private capital typically.
Thanks, Shaun. Accessing private capital, we'll touch on it at a high level. It's probably a workshop in its own right, to be honest with you. But I guess in a high level sense, the first important criteria is to identify your needs. We've touched on this. There's very much different types of money for different types of situations. So understanding what is the reason for the need is first and foremost an important consideration. Is it for growth? Is it for turnaround? Is it to buy an asset, for example? All has a bearing on, what type of capital is best suited, and therefore what does the best and perfect, if there is such a thing as a perfect investor, look like. I guess our message would be, don't do this in a vacuum. Seek assistance. There's a myriad of different types of private capital around that we've just touched the surface on. So knowing what's available is pretty important to making sure you get the best outcome. In terms of identifying the need, there's then, I guess, a case of building a preliminary shortlist of who the most appropriate provider of that capital might be. Now, private capital it's not a dark world, but it's certainly not as prevalent as traditional debt lending. So there's a bit of a case of you don't know what you don't know. And the private capital market relies heavily on advisor networks for what they refer to as deal flow. So advisors tend to be very well informed about who's looking for what and what might fit what your need is. And we touched on there's lots of options, but understanding which is the best option and more likely option up front that's going to meet your needs can save a lot of time going down a lot of dry gullies across the various providers. It's then important to understand what that potential private capital provider is going to be looking for, and what the key metrics are going to be for them, particularly around due diligence, what your system's like, what's your reporting like, what's the quality of information you're going to be able to provide, because the more that can be done up front and provided in a form that's attractive, the easier the path to securing the capital is going to be. So in terms of sort of pre-positioning your business for success in terms of accessing private capital, it's important that you best present your business to extract maximum value. A 3 to 5 year business plan, for example, is an important component of that. Now, business plans mean a lot of different things to different people, so it doesn't have to be War and Peace by any means, but knowing where the business is looking to go and how that private capital is going to assist with that is vitally important. So that messaging is very key. Ensuring your earnings profile is presented appropriately and in the best possible light. Make tough decisions on costs and underperforming parts of the business. Ensure EBITDA performance is optimal, and or probably more pertinent, that your forecast EBITDA is supportable and is showing appropriate growth. Get some housekeeping, clean up the balance sheet, look to make sure you're optimizing your working capital, particularly show that you're only seeking the amount of private capital that you really need, and that there's not other levers you can pull to reduce the amount of that capital need. Resolve any legacy liabilities, non-business related matters. If there's a heavy asset backing and there's sort of some plant and equipment, land and buildings, etc., make sure the valuations of those are up to date and current, and position in the best possible light. And also the whole, make sure that the corporate structure is appropriate to consider tax consequences around CGT, access to losses, minimising liabilities, etc., and consider if there's optimal processes for transfer of assets to perhaps a more investor-friendly type entity. So I guess having got your ducks in a row and done the housekeeping and got the messaging and storing right, in most cases there's likely to be more than one potential path of a private capital provider, particularly if it's got most of the key characteristics we've talked about. So then it's a matter of making sure you choose the right path and you choose the right partner. And there's, I guess what we refer to as running a process. And a process can be as structured or unstructured as needed, but having some sort of process is still important. So have the right advisors on board, legal, accounting, M&A, particularly to help you with that upfront housekeeping matters. Get assistance to present the opportunity in the best possible light through an opportunity profile, input into a knowledgeable target list of who is worth approaching and who's the most likely to be interested. And this is where the knowledge of your advisor and the networks that private capital providers rely on is important. And then presenting that opportunity to that right audience in the right manner. Behind the scenes for all that is getting ready for due diligence, and due diligence will still be extensive. I mean, private capital doesn't mean it's due diligence light in any sense. So, in fact, arguably, it's more extensive. So, building a data room that's populated with all requirements for due diligence is important. Make sure that the data reflects the key transaction elements in easy to understand format, and the quality of data often does drive transaction success. So spending the time to ensure that that data is quality in the preparation phase is vital. And again, it's a case of qualifying interest, getting confidentiality agreements in place, issuing the IM and access to data rooms, and then set some sort of timelines and preferably competitive tension to make sure that you're getting the best possible outcome. So that's a high-level overview of how do you access it.
Thanks, David. So look, that brings us to the end of our slides. I might just briefly recap on what we've covered. So we've talked about the current environment, the impacts on capital. What we're seeing, I guess, the summary from that section was that we're in a circumstance where some of the traditional capital providers may find it difficult, or I guess put a few more hurdles in front of businesses as we go through the COVID scenario to access capital, and that there are significant amounts of private capital that's available in the market that might have a similar ability to provide the same sort of service. We gave a bit of an overview of what private capital is, and we've hopefully tried to demystify that at a basic level for you. We talked through private equity and private debt, the different types of both of those, where they're typically used and how you access them. I think the bits that we'd like you to take away from this are a couple of things. First of all, that if you do have a need for capital, whether that be to grow your business, whether that be to fund the current cash flow position or bridging position resulted from COVID, whether that's because you want to exit your business, for example, and sell to somebody else who can take it to the next level. Irrespective of what your position, there is private capital opportunities available in the market now that weren't there sort of a decade ago. And they can typically be things that can be sourced for any particular purpose that you need. Now, the other side of it is that when you access that private capital, what's really critical is the advisors that you use, and this is a bit of a plug for us, I guess, but it's critical on the basis that you need to understand who the right private capital sources are. You need to understand how to access them, and there's not you can't just type an address into a website, and there's not a phone book that you can go to for these types of lenders. Typically, you've got to be able to have an advisor that's got networks that can connect you to them and can help you understand which are the right capital providers to use in different circumstances. So look, that's probably all we really wanted to cover today. We've got just enough time. We've got a few questions that have come here through. I've probably only got time for maybe one or two. David, I'll throw the first one to you, which was, are private wealth angels expected to provide opportunities for growth?
Yes, absolutely. I think they'll only invest if there is growth, but I think if they can't provide more growth opportunities than you could on your own, they're probably not the right partner. So them adding value to existing growth capability, yes, is vitally important.
And another question that we've got here, which is always a bit of a chestnut, I guess, is it says for asset-backed opportunities, what sort of total returns are they seeking, and what quantums of equity contribution will they make?
Oh yeah, look, that's pretty broad brush. I think as a generalisation, the hurdle rate for, and I'll talk about private equity, kind of their minimum threshold is an internal rate of return on their capital invested of 25%. That's a pass mark. So yeah, the other nuance there is time to achieve that. So if a PE investor doubles their money in 3 years, this gets them their pass mark. Now, if the investment hold is longer, obviously the times money hurdle goes up. So, you know, to get the 25, if they hold it for 5 years to get the 25% IR, they need 3 times money. So that's kind of a broad answer to the question, but it really, the short answer really does depend. In terms of amount of investing, it really depends. You know, venture capital can be smaller amounts. Growth capital can sort of be, you know, up to $50 million, and you know, the global PE funds, kind of, there is no limit.
All right, thanks, David. Look, we're pretty much right up against our 10 o'clock end time, so we'll call an end to it there. If you do have any other questions that you want to raise, please feel free to contact David or myself, and I'll put our details back up there for you. We will also circulate a copy of this presentation via email to all the different participants that were registered. But that's the end of the session. Thank you very much for your attendance. We greatly appreciate it, and hopefully we'll hear from you again soon.
Thanks, everyone.